Wednesday of every odd month. And as we are odd this month, we are going to jump in. Um, this is the same format that we have every third Wednesday. Basically, we have our speaker speak, and when he's finished, you can ask questions of the speaker, and you can also ask questions that have nothing to do with what he's been speaking about, just to have like an open conversation about anything to do with investing. So today we're very excited and lucky to have with us David Dawes. He is the okay, where's your actual thing? I have the thing about you. Oh, here we are. David Dawes is the founder of CKC.Fund, which brings decades of experience in structured finance and investment strategy, offering insights into how institutions, asset managers, and HNWIs can optimize their exposure to crypto. With a focus on capital efficiency and risk-adjusted returns, CKC.Fund provides sophisticated strategies for navigating both bull and bear markets. Join David as he unpacks key market trends, the role of structured crypto investment, and how investors can position themselves for sustainable long-term growth in digital assets. And I know we're all very curious about crypto. We all want to like dip our toes into it, but we don't want to lose our shirts. So David, over to you.
All right. Well, thank you for having me on, Christine, and thank you everyone who joined. Yeah, I like that. Dip our toes in, but don't lose our shirts. That's two good goals for crypto overall. So yeah, I have just a fairly brief presentation that I prepared on kind of just a crypto 101, so to speak, especially as regards more risk mitigated investment approaches. So would love to walk everyone through that, and just relatedly though, would love to answer any and all questions at the end of that as well. So first off, just thinking through, what we do on our team at CKC is really we're focused on leveraging digital assets to build wealth, manage risk, and capitalize on emerging opportunities in a way that that is balanced and that brings to bear fundamentals and fundamental and technical principles that apply across markets. Just a real quick disclaimer here that this is for general education purposes and not meant to be tailored financial, legal, or tax advice. And with that, just real brief on myself and the team. And Christine kindly introduced me, but I would just say the kind of broader theme across the board here is that we are focused on basically, I would say, one foot in the crypto universe, so to speak, and the other foot in the traditional tech and traditional finance realm. So, from myself, I'm ex-Citi, but also have worked in multiple different top crypto-related companies over the last. Been in crypto over the last roughly 8 years, so I've seen quite a few adventures in this space. And then we have others also that for example, come from, Wharton, BlackRock, et cetera, but have also managed 8, 9, 10-figure portfolios before, both in crypto and outside of it. And as part of what we do, we also are very active in the global event space as part of our overall research, as well as part of our overall community building. That includes events in Davos during the WEF in Switzerland each year, in Beverly Hills during the Milken. And this is something where we build a community of like-minded investors in the alternative asset arenas, but also something where this helps to supercharge our own due diligence practices and related. But with that, I'll get to the main event, which is really talking about this high potential market overall. And over here, really just meant to highlight a few examples of where markets in general have risks, and this is something that that we all do well to bear in mind that the traditional narrative on over the years, which is starting to get better, has been that something like crypto is inherently risky, whereas something like real estate or treasuries, bonds, etc., are inherently safer. But just looking across time horizons, there are various moments where kind of these tried and true asset classes, so to speak, have been tanking when crypto has actually shown itself to be the digital asset market has shown itself to be very anti-fragile, very resilient. And the broader point, though, being that a well-balanced portfolio in general is something that can incorporate real estate, stocks, bonds, but also gold, alternative investments, crypto, and digital assets. And really, that broader tapestry is something that can lead to more resilience, where when some of these assets are zigging, the others are zagging. So with that, I find it just really interesting that Bitcoin in 2023, in a year that was actually a bear market for the crypto industry, Bitcoin actually was the highest performing asset of versus say S&P 500, oil, gold, various stock and bond indices, as well as commodities. And so relatedly, though, over time is something that has returned thousands upon thousands of percent. So with that volatility comes great upside, something that is ultimately an asymmetric risk and reward equation, where it can make great headlines in the media when Bitcoin goes down 20-30%, but at the end of the day, it is something that has been going up actually thousands of percent over the course of a decade plus. With that, also, depending on where we are in various markets, something that where we've seen Bitcoin and digital assets showing anywhere from moderate to low correlation with other asset classes like gold, oil, stocks, treasuries, etc. And so then something where a minority allocation into this can make a lot of sense in terms of basically bringing low correlated upside to a broader portfolio. Something that we actually talk about, an article that I co-authored was featured in the Bitcoin Market Journal, talking about applying kind of more tried and true approaches to portfolio allocation, looking at for example how a modern portfolio theory framework could be applied to crypto and digital assets, is something that our team looks at, but also something that a lot of other research has looked at. So overall, looking at, for example, it depends on the overall, I would say, the overall institution and what demographic they're serving. But we've been seeing, for example, even on the very conservative side, BlackRock was up until a year or so ago was recommending, I believe it was 0.5% to 1% allocation into crypto for its ultra high net worth individuals that it was serving, institutional clients that it was serving as well, and has recently doubled that to more in the 1% to 2% range. But then we see others such as ARK Invest that has been recommending, depending on the clients, up to, I believe it was 10% in some cases being allocated to the digital asset space. But overall, if we look at kind of the preponderance of evidence, surveys of family offices, high net worth individuals, modern portfolio theory analysis, et cetera, certainly we'll see a wide distribution of preferences and tendencies, but overall, it does seem to indicate a preference to somewhere between 4% and 6% of overall net worth being allocated into into the crypto space among, let's say, serious investors, including family offices and ultra high net worth individuals. And with that, we're also seeing now that the digital asset space in and of itself is something that has overtaken the size of, say, Google in market capitalization, also the size of the silver market in overall market capitalization. The point there being that this is now no longer something that is fringe, is now something that is bigger than a lot of mainstream investments. With that, there are roughly this is, I guess, a range depending on who you ask, but by my definitions, there would be over 25,000 different digital assets. Some will say closer to the millions, but there's I guess a lot of very, very tiny projects that I'm personally not counting in that. But to that point, even if we're calling it 20 to 30,000 different assets, this is something that is an entire ecosystem unto itself. So that's actually one of the reasons why my team and I prefer the term digital assets, because cryptocurrencies are, as we see it, really a subsection of that. Not all of these digital assets are intended to or should be used as currencies. Some of them are stores of value. Others of them can be used to facilitate decentralized infrastructure, basically the next building the next internet, so to speak, applications that are more resilient to hacks or to security threats, more resilient to protection against bad actors, governmental or criminal or otherwise. And so really we see an overall ecosystem where this is much beyond Bitcoin. So an example I use is, if you have the stock market, yes, there's Microsoft being, towards the top of the stack in market capitalization, but you also have a whole lot more beyond that. And so with that, you have in the stock market, healthcare stocks, industrials, financial services, various other use cases, technology. Somewhat similarly, in the crypto sphere, you have assets that are at different market capitalizations, your blue chips, your mid caps, your low caps, your micro caps. But then you also have different utilities and use cases, such as the decentralized storage or decentralized finance, some health applications, supply chain, and various others. So, broader point there being that even though there are different rules, as I like to say, this may be apples and oranges, but at the end of the day, it's still fruit. The fundamental principles still apply of utility, use case, value propositions, financial models, and the like. So with that, these are examples of where some of the opportunity is really in conducting nitty-gritty fundamental and technical analysis, looking at things ranging from token economic models to price projections, yields, consensus mechanisms, all of this various stuff. It's something where, granted, there's not the same level of a blueprint, of a time-honored blueprint for fundamental and technical analysis as in other asset classes that have older or longer histories, but it is something where nonetheless their canon should be that same level of rigor in analysis and research and decision making. So ultimately, that is where the opportunity can be, is in essentially applying that level of rigor and forming one's own models, one's own research in an exciting new emerging asset class like this that doesn't have everything operationalized yet. So with that, a couple of different aspects of where where some of the catalysts are in this overall space at the moment. So for one thing, tokenization as a huge opportunity, tokenization of real world assets. Analysts at high profile institutions such as Citi and the WEF have been forecasting a 10 to 30 trillion, I believe, dollar market capitalization for tokenized real world assets such as real estate, oil, gold, private credit, private equity, etc. And so essentially, something where we are likely to see truly exponential growth in that arena. The other being regulatory advancements that, as much as 2022, saw a lot of bad publicity in the space around FTX and related areas. Really, the industry has been growing out of the ashes of that much stronger and much more well regulated across the board. Something where we're seeing in the US, for example, increasing openness to not just cracking down on kind of the stick side of the equation, but also more of an opening up to the carrot side of what can be done, what should be done in this space. Conversations around things like strategic reserves at federal or state levels, rapidly opening up in the U.S. as well as in various other countries around the world. And also, regulatory advancements, not just in the U.S., but in various other jurisdictions, such as in Europe, in the United Arab Emirates, and elsewhere. Beyond that, we're also seeing a preference of the vast majority of high net worth individuals and family offices showing interest in digital assets as of now, as much as 80 or more percent being interested in allocating into this space as of now. And with that, also, we're seeing that strong predictions of Bitcoin price being anywhere from 1.5 to 2.5x plus from where it is now, from let's say mainstream analysts and key opinion leaders such as in VanEck or Fundstrat or elsewhere, and notably with ARK Invest's Cathie Wood predicting a 7-figure price for Bitcoin by the end of 2030, which will be upon us before we know it. So with that, some of the areas that we seek, for example, and various more institutionalized approaches seek to apply to the space is to essentially use the asset class as a hedge against risks in other asset classes, such as in the stock market, the real estate market, hedge against the US dollar and other national currencies. This is something where I'm just remembering, when I started in the digital asset space about 8 years ago. I remember looking up. There were, I believe, what I was calling the 15 over 15. There were 15 countries around the world that had 15% or more annual inflation per year. But in recent times, in a post-COVID world, it's really closer to, last I checked, it was more like the 30 over 30, that basically inflation around the world has been much more rampant. Something that, hadn't really been as strong of a conversation in the US is now, been very front and center of late, and even more so in various other countries. Also, the other application of this is diversification, that while Bitcoin is, the biggest, baddest player on the digital asset block, it is also, one of very many, as I was remarking previously, and also is one of many that are solving various other use cases than what Bitcoin is. So, where one of the opportunities is to be capitalizing on the growth of multiple different use cases. And then the other aspect of digital asset investing in let's say the next generation of digital asset investing is risk mitigation. That, at the end of the day, there are risks associated with all investments, and some of them are specific to the digital asset space. But these can and should be mitigated through infrastructure, um, audits and financial reviews, uh, proper custody relationships, insurance, analytics, etc. Something that, as relatively new as the space is, are accessible to this space in somewhat similar ways to how they might be in equities or in real estate or otherwise. And then some of the other opportunities here are also total appreciation, somewhat similar to how one might approach the stock market, where there are various digital assets that are not just uh, that are not just offering capital appreciation of increase of their token value over time, but that are also in some cases providing yield, somewhat similar to um, let's say a dividend stock or similar. And when that is automatically reinvested, which functionally in the digital asset space is just about always the case, is something that can provide compounded um, total appreciation. So beyond that, uh, as I was saying about risk mitigation, just that this new wave of investing here ultimately is something that takes on these tried and true principles and approaches. A lot of the bad publicity that the kinds of stuff that a lot of us may have seen in the news over the last few years. A lot of it ultimately came down to a lack of accountability and also excessive leverage and excessive risk taking. So at the end of the day, that's something where having multiple parties involved, having security practices to limit risk exposure, to provide transparent reporting and communication are something that we see, and a lot of people that are really committed to this space see as the next as what is going to propel this space forward. I'll give you also just a couple of examples of some of the types of strategies that can be out there in the digital asset space. So this is more of what we might call a beta plus type of a model of basically seeking upside beyond Bitcoin. And so it's something where there is greater risk, but when actively analyzed, monitored, managed, that risk can be reduced. But there's also greater reward, where when Bitcoin is going up 20%, 50%, some of these other digital assets that are smaller size, that are let's say higher growth potential, are going up 2x, 5x, 10x. And so that's where, for example, diversification with total appreciation can come into play. Diversification not just by a market capitalization, but also by use case and value proposition. Another example of a strategy in digital asset investing would be, for example, more of a momentum style of investing. Say taking a list of several hundred high potential digital assets and analyzing which of these have the most favorable momentum scores on any given period, such as a week, 2 weeks, 4 weeks, etc. And then moving into just the highest scoring of those. So the question there is essentially what in any given time period is going to be that 98th, 99th percentile of highest potential assets out there. And there are various other strategies in the space, somewhat similar to how there are multiple strategies to real estate investing or to to equities investing, et cetera. But some of those include more yield-oriented strategies, more market-neutral strategies that are focused less on appreciation and more on income and dividends. Also, there are increasing numbers of structured products out there in the space, as well as more mining and staking and more private equity type of investments. So with that, as I mentioned, I'd be very happy to answer any questions, but just a few other thoughts would be glad to keep in touch for those who are interested in this space. I'm pretty active on LinkedIn, and that's my LinkedIn URL right there. And then we also have a newsletter, monthly newsletter on the digital asset markets that we put out on the CKC LinkedIn. I also recently published a book, which is available as Kindle, paperback, hardcover, and audiobook as well. And if you'd like to reach out to me through any of the channels listed there, I'd be very happy to send you a free copy of the book as well. So yeah, with that, thank you all for your attention and your time, and would be glad to answer any questions.
Excellent. David, thank you so much. Folks can either put their questions into the chat or feel free to come off mute and just shout it out. We'd love to hear what you have to say.
Yeah.
Yeah. Yes, David. So do you favor regulation, and what's happening in the regulatory area right now? Because one of the things they say about crypto is, hey, maybe, you don't really need regulation because, the way the blockchain works, you don't need it. So perhaps you can address that.
Yeah. So it's a question that a lot of people are asking, especially over the last few years, and different countries are going to have different answers to it. I think a couple of things. One is that historically, you'll see certain patterns for how the U.S. approaches regulating emerging asset classes and emerging technologies that are different than other players in the space. So, for example, let's say China has tended to more, let's say, just categorically ban certain new technologies and then slowly ease up on the regulatory frameworks. And we saw that with, say, peer-to-peer lending, various things over the decades. Conversely, the U.S. tends to kind of leave an open field and then slowly kind of create more of a framework. So there's kind of that in tighten and loosen up sort of approach, or that's loose and then slowly tighten approach would be examples. I think that with where we are right now with the US, we have arguably one of the more pro crypto administrations of in the US so far, as I would say almost definitely of the US so far, and arguably of most major developed countries in the world so far. And so with that, we have been seeing for example, new opinion letters and other documentation coming out from organizations such as the SEC, Securities and Exchange Commission, and others that are starting to basically take a more active but also more open-minded view on a lot of digital assets. We're also seeing increasingly many of the top blue chip digital assets starting to get listed on the stock market as ETFs. So Bitcoin and Ethereum for now, but very likely soon Litecoin, Cardano, Solana, possibly about half a dozen others as well. And so with that, will also come kind of a more regulated framework for investors to access the space. And then ultimately also, though, I think we'll be seeing a bit of regulatory arbitrage where basically businesses, investors, et cetera, are going to where they feel they're treated best. where there are certain frameworks that are just going to be, on the one hand, more investor friendly, and on the other hand, more rigorously regulated for certain subcategories of the space, be it digital asset banking or digital asset exchanges. And we're seeing different countries kind of form their niche areas of expertise. And then the last point on that would just be that also this principle of technological leapfrogging, that so far it hasn't been a huge priority for the US to really go after this space so much until now, partly because it has one of the strongest kind of legacy financial systems in the world, whereas we do see a lot of other smaller countries and or emerging markets that didn't necessarily have that strong of an infrastructure, that are just going full speed ahead on this. So the way I think about that is, say, the adoption of cell phones. The US had one of the strongest landline systems in the world. I just remember growing up, the call boxes, every mile or so on the highway, and now that's completely obsolete. There were countries that just never had that adopted cell phones way faster than we did in the US. But then now cell phones are the global standard. I could see something like that happening as well, where the US is essentially starting to become more and more open to this, but they're not the ones that are moving the fastest on it, if that makes sense.
Hey, David, if I may ask,
Yes,
what do you
please.
think about some of the ETFs that some of the, Fidelity and other brokerages, they actually are focused on these digital coins and digital currency?
Yeah. So I think the consensus on ETFs for digital assets is a bit mixed. So there are a couple of factors. Some, let's say, more the bears will argue that that basically the demand for the assets that are potentially going to be listed is already there, and that listing them as ETFs will not actually increase the demand. The bulls will say that this will open up new outlets for for basically non-crypto native investors, especially institutions, to get more exposure to these assets. I tend to think that that it's likely a bit of both, in a sense, where often we see some of these this news getting traded a bit in advance, where essentially the upside to the prices for some of these assets that are potentially going to be listed as ETFs can be a bit baked in to before the listing. And so then when they're listed, people often are expecting some magical transformation, but that price upside has been baked in. But then very often what we also see is that over the course of several quarters, several years, that there is more longer term upside to it. The other part, though, that I'm unsure of is how that will affect those assets. So the assets that do end up being listed as ETFs will likely become more correlated in their price action with the stock market. So this provides opportunities as well as challenges. I would say that that does open up, let's say, it opens up more liquidity, but it also means that the assets not yet listed as ETFs may likely be the ones that have more price upside for let's say somewhat similar to say the public stock market versus pre-IPO investments.
Yeah. No, I mean, one advantage of some of those ETFs is they're a little more stable. Of course, the return is also much orders of magnitude less, you know. But
Yeah.
but I mean, the volatility is less in the ETFs. That's what I think. So
I think that's very, very possibly the way that this may go.
Yeah.
I agree, and so that's where the that's where really in my view of digital asset space, there are almost four sub markets in a sense. There's the public market of the ETFs.
Mhm.
There's what I would call kind of more let's say the like mainstream crypto exchange markets, say what's on Coinbase, etc.,
Mhm.
which basically you just need to log in, username, password, link your bank account up, fairly streamlined. Then there's the decentralized markets, DeFi and such, where you basically need to go into a self-custodied wallet and in order to access these, and that's another layer deeper that many people are not able to go, or might not have the time or inclination or knowledge to go into. And then a level lower than that, you have essentially pre-seed type of markets, in a sense, of these initial exchange offerings, initial coin offerings that are largely more the purview of let's say crypto oriented venture capitalists, or or sort of very long-term oriented angel investors. And each of these has different risk reward sort of profiles, different liquidity, but ultimately I see things like ETFs driving more mainstream acceptance, but also for the specific asset that's listed, as you said, kind of reducing a bit of the volatility. But then as people experiment and become more familiar with that, I see the likelihood of them going a level deeper into those other markets being much higher.
So,
Yeah.
David, the ETF route would then kind of work against the anti-correlation that you talked about before, probably.
So it's possible that is the case. So for example, right now some of the largest hedge funds out there are trading, I believe it's four stocks. One is the Nvidia, the other is Berkshire Hathaway, the other is Bitcoin, and I always forget what the fourth one is. But basically, that's just very, very, very concentrated capital in a very small pocket of the stock market. And so we are already starting to see Bitcoin kind of separate out from the rest of the crypto market in a way that basically to your point, it's starting to much more closely sort of correlate with some of those top stocks. So I see that as is an opportunity both for Bitcoin and for all the others that basically the more that people are seeking low correlated returns, the more they will be moving out of the ETFs and into the rest of the crypto market.
About exchanges, I think you mentioned just one. How many are there? A lot of exchanges, and do they work just like most of the other exchanges, or anything different about them?
Yeah, so there are quite a few exchanges. I mean, there are I mean, hundreds to thousands. It's sometimes hard to keep track of these things, but I would say hundreds of fairly well-known ones, and then thousands of possibly just smaller, more kind of mom and pop, so to speak. They're not all of these are created equal. Some of them have better or worse security practices. Some of them have more or fewer selection of digital assets. Some of them can be accessed only in specific jurisdictions, or some of them cannot be accessed in specific jurisdictions. I would say something like Coinbase, for example, is popular in the US because it's a US company that's a publicly traded stock on a US stock exchange, has US audits, etc., reserves, all of this stuff. But at the end of it, the other aspect to that is that the exchanges, many of them that have let's say that are kind of open to the public, also are not necessarily the best places to be custodying assets long term. So if something happens to an exchange, such as a hack or a bankruptcy, etc., then one can, you know, potentially lose access to those funds. And so that's where more institutional type approaches will seek to have, you know, insured custody accounts, or else like multi-signature cold storage accounts. I'm throwing out kind of a bit of jargon there, but basically there are risks that exchanges can open someone up to that, you know, that are the sorts of things that more institutional approaches seek to mitigate. But then beyond that, what I'm mentioning is really all what I would call the centralized exchange market, which is where you set up a username, a password. If you forget that password, you contact customer support, they help you out, that sort of thing. Somewhat similar to, say, you know, at a bank. But then beyond that, there are also decentralized exchanges where you have your own, basically a wallet where you have basically a secret phrase, and you make the decisions on what what to trade, etc., solely on your own. Those are ultimately those decentralized ones are, some people prefer because there's a wider access to basically many different digital assets. But also there are risks with those, such as losing or forgetting the secret phrase. That's a scenario where if you don't know that phrase anymore, functionally speaking, you don't have access to your funds anymore. Or if you give someone that phrase, they have access to your funds now, right? So these are the user experience kinks and the specificities of the crypto world that require, doing your research, having a plan, being prepared. I think we have a question also from a Pope. China seems to adapt to technology fast. However, the equipment is very, very cheap there compared to the USA. Would you agree with that? Yeah. So, well, as relates to crypto, China has been a bit of a tricky, I would say, tricky scenario regarding crypto. So we've seen the Chinese kind of authorities come out very strongly against crypto at various points. Some detractors have argued that this is potentially market manipulation, where we've seen some wallets coming out of China, basically, that are making massive purchases the moment after major announcements from the government are released, that sort of thing. But also there has been criticism from, I believe, from the Chinese government around basically the outflows of capital via crypto out of the country, which has been a challenge. But ultimately, for example, as you're saying there with the technology, I mean, there's a decent amount of crypto mining, so basically generating new cryptocurrencies. That's been happening out of China with access to high quality, lower cost equipment. There's also at this point a lot of questions about what the future of crypto and artificial intelligence will look like. That involves what's going on in China with, let's say, DeepSeek, new artificial intelligence model, versus the more US and European AI models. But yes, ultimately these are, with all of these emerging markets, there are, I think, a lot of opportunities to consider around emerging asset classes, because a lot of emerging markets do tend to be more embracing of these emerging technologies and asset classes.
You made a good point. I'm a Pope. Oh, you can see that. I'm Anitra. You made a good point about, hi, nice to meet you too. I like your presentation, but you made a good point about cognizance, memory, remembering your password. And that's, even though when Bitcoin and came out, I was a lot younger. However, I always had in the back of my head, what if I lose? And if you don't have any family as you age, for those who are population is aging, you can't give your password to your attorney. That
Yeah.
would kind of be hard. So, and then you said, so that's why I loved when they came out with with ETFs, because
Mm-hmm.
it gave you an opportunity to be in it with a
Mm.
safety net of not having to fall on something like that. But then
Yeah.
you said something about you could move from the ETF as time goes on. Sometimes people will move from the ETF to, I guess, individual types of current Bitcoin
Ye-
currency.
Uh, yeah, so you raise a couple of I think really relevant topics, and I mean one of them is the broader legacy planning and security components that basically passing crypto on to the next generation. These sorts of things have become big questions, and that's something where basically. Uh, there are solutions, many of them not particularly simple, and as you say, there are risks around, say, giving private key or seed phrase password to to other people, even an attorney. There have been horror stories of, say, bad actor attorneys, kind of running away with the bag and having it be very difficult, if not impossible, to prove it was them. So that, anyway, the broader point there not being to make people scared, but just to think through that yes, you're absolutely right, that legacy planning is a solvable. It's a very important part of this, a solvable part of it, but something that's important to go about properly and carefully. Other point you were making about moving from, say, ETF type of crypto exposure to say more direct crypto exposure. Yeah, I mean that's there are various different ways to get access to crypto. The ETF part certainly has a certain convenience factor to it. At the end of the day, though, some people will prefer to get directly purchase crypto, or invest with people that are directly purchasing crypto on their behalf, because of partly question of ethos of having direct, let's say, owning the crypto versus owning an ETF that holds the crypto. Also because of, as some of the questions that Sriram and Milburn were asking, because there are a lot more crypto assets that are not available on ETFs, a lot more of those than there are ones that are available on ETFs. So point there being that some people will start with an ETF and then move to the other opportunities that are harder to access, because oftentimes when things are harder to access, that can also mean that there can be more opportunities in them, if that makes sense.
Yes, thank you. It's just that you can't transfer it out of the ETF. So it's almost as though if you're later going into it a different way, you're almost starting from scratch, like someone that's trading for the first time in that currency. Is that correct? That's my last question.
So I'm not sure if I understand your question correctly, but if I got that, then yeah, I mean, if you were purchasing something like an ETF, that would be you're generally purchasing a stock through a stock trading platform, whereas if you're buying crypto directly, it's often through a different channel. So there's not necessarily, at the moment, there are not too many ways I'm familiar with to just go seamlessly from owning an ETF to owning crypto directly. It does take a few steps of, say, selling the ETF into, US dollars, and then taking the dollars and, buying a cryptocurrency. Yeah. And Milburn, I think you were asking what was the entity that had 4 holdings. It wasn't so much any one single entity as more this was would say there are more a broader trend that there are quite a few large institutional investment groups and hedge funds around the world that have just really outsized holdings in those particular assets, and that this was kind of creating a broader kind of vortex of energy in the markets, so to speak.
Like very concentrated, I guess. That's
correct. Yeah.
Great. Are there any more questions for David? How about any other questions about any other topic? All right. Well, thanks everybody for joining us, and be sure to be here in 2 more months at the next odd month. And is that, Mel, is that your presentation in 2 months, or are you?
Yes, I think I'm on tap.
All right, great. Do you want to talk about your presentation real quick? Tempt people.
Yeah, I mean, trying to use some of the large language models, the AI applications for stock research. So it's, nothing quite as intense as what David is talking about, but there are certain things that can speed up your analysis of a company, and then comparing the different large language models, Gemini versus ChatGPT versus Llama, that sort of thing.
All right, so super. So be sure to be here for that. David, thank you again so much. This was really informative, and I think people really enjoyed it. And don't be discouraged that there weren't a million people here tonight, because a lot of people do catch it on YouTube later on. There's sometimes competing meetings on Wednesday night. So
yeah, no, as I appreciate those who are listening live, as well as those listening to in the future, and appreciate everyone's time, and would be glad to to stay in touch and to answer any questions people have offline as well.
Good stuff, David. Thank you very much.
Thanks again.
bye.
Good night, everyone.
So who's recording? Sure, are you recording? Oh, you left.